Hello, Melvin. How are you today?
Hello, I'm good. How
Uh,
are you? Good
yeah,
too?
very good, very good. Yeah, excited to get another of these sessions under our way. I think, this is one of our more, I would say, introductory kind of sessions, right? And I think this one's fun to do because I think the last few sessions that I've done have been a bit more advanced in nature.
Hmm.
We're talking about smart beta and RE, so I think this one is a bit more fundamental. So very useful for I guess people who are just getting started off on their investment journey.
I remember we used to do this in physical
Physically,
seminars.
I remember. I was seeing some of the slides. I remember those from before, and it was across town, right? Across hotels, towns, co-working spaces. It's the new digital world we live in. All right. Are we? You think we're good to start off? What do you think?
Definitely. Since it's 7:05, let's get this rolling.
All right, guys. All right, wonderful. All right, thank you everyone for joining us today for our webinar. As I was just briefly speaking to Melvin just before we kick started, this is one of our more, I would say, introductory kind of sessions. Of course, we will be happy to answer any more, I guess, technical or more advanced questions that you might have. But we have even specific webinars for them, and something that we'll touch on as we get along. So if I basically, see the premise of finding Syfe in some angle, but also generally one of the key, concerns that we normally see investors, or the issues that they normally end up facing, is typically boils down to these, like, four kind of situations, right? I think first and foremost, they're obviously a bit upset when they underperform, whether it's a benchmark, whether it is, an index, whether it is their peers. I think that is one thing, which brings, people a little bit of discomfort in some way. The second thing is, of course, if they're normally just going through a regular, a typical advisor, or they're going through one of those complicated structures of structured products and so on and so forth, then there's a lack of transparency. They really don't know what, they're getting into in some ways, right? Then the other thing, of course, is fees. And again, some of these structures, there are all these, like, layered fees, and something that we'll touch on a bit later, right? Because sometimes you might think, oh, it's only 1 or 2%, but in reality, it actually is much more and much more significant, the impact of it. And then lastly, of course, there is the aspect of emotion and bias, right? And I think this is very, very critical. I think almost everyone wants to believe that they can, beat the markets and, get things right. But in reality, these emotions and biases normally, more often than not, work against you as much as they, work for you. So what we wanted to say was that these are the kind of, bigger problems that generally end up, facing investors. And I'm sure if you are on that investment journey, whether you are an existing, or you're relatively new in the whole setup of investing, somewhere within this you would have had some, some issues, right? So let's just take, a step back and then say what are essentially, the original, when we really look, if you're starting off investing, what are the six things that, you should really, really look out for, right, when you do. So first and foremost, I think it's very important that it pays to invest today, right? As the saying goes, that the time you have in the market is much more important than timing the market. Now, I think this takes some time to digest in some ways, but the reality is that, if you can just stay out for longer, you will, end up benefiting more, right? And this, is a classic example of this, right? So you can take, two examples out here. We're taking, simple Jack and Jill. Now Jill, starts investing in her 30s, but only for a span of 10 years, right? Just invests 10,000, total of just $100,000, right? Now Jack also invests 10,000, but only starts when he's 40, but goes up to 60, so total of $200,000, invested. Now the question for you is that, who of them, that's a pause already up, who of them will have, a higher, I guess, net wealth by the time they turn 65? To be put it very simply, they have the same, rate of return, but Jill essentially only invests for 10 years between 30 and 40. Jack invests between, 40 and 60. So if you guys can see, there'll be a quick pop-up if you guys would like to choose whether it's Jack or Jill. Okay, we give it a couple more seconds. All right. Vivian, do we have some of the answers of this one? So this actually is interesting, right? That because even now, like, 28 or 30% of people, and almost 3 out of 10 people believe that Jack will have more, right? I mean, and that's actually, it's interesting that so many people still believe that Jack will have more. The reality is, and the right answer is, it's Jill who will have much more, right? And this is the power of compounding. This is the power of, spending more time in the market, right? Just because Jill started early, Jill will have just much more to gain as she spends, more time and keeps on reaping those returns. And if you see the difference, it can be actually significant, right? If Jill invests technically half the amount and still ends up getting almost 50% more by the age of 65, right? Now, of course, if you increase these amounts by a higher value, let's say if you're investing $10,000 a month, you can just see the scale of this and the magnitude of that can be very, very important, right? So if you can see, though you're contributing more, if you contribute late in life, then your upside is somewhat capped. Now that doesn't mean that if and I know some of our listeners will be in their 50s and 60s, doesn't mean that you don't start, right? I mean, you're still losing out if you don't invest at all, right? But if you can start early, right, I think that will really, really benefit you. Of course, circumstances allowing. Great. Now, the second thing is, and you must have heard this thing, don't put all your eggs in one basket, right? And I'm not sure if this is seen very clearly. At least if you're on a big screen, you should be able to. It's a little tricky on smaller screens, but what this chart actually shows you is that performance of the different sectors in different years, right? And if there is one common theme that comes out of it, right, is that there is like no predictable trend, right? I mean, there is no real thing that one particular sector will always and always keep on doing well, right? I know this year is a year for tech, but that doesn't mean that this will always be a year for tech in some ways, right? And just to take a simple case, an example, right? Just look at commodity in the last 3-4 years, right? In 2019, commodity, for those to point it easily, is the yellow, the bright yellow thing that you can see on the screen. So if you look in 2019, commodity gave an 8% return, but in 2018 it gave a minus 11% return. In 2017, it gave a 2% return, right? So there is literally no kind of fixed pattern that you can expect year on year on year. And because investing is something that you do over time, trying to get one sector and get it right is going to be very, very tricky. So always and always, when you can build a diversified portfolio, this really helps you against unforeseen circumstances. Take, for example, COVID. If your portfolio was heavily, let's say, into airline and hospitality, it would have taken a massive beating. But a more diversified portfolio would be a bit more resistant, to it. So as the saying goes, diversification is the only, free lunch left in town. And when you are building your investment portfolio, keeping it diversified can go a very, very long way in you optimizing the output that you can get of that portfolio. The other thing, or I would say our third principle, is to manage risk over returns, right? And as some of you might know, this is the legendary investor Warren Buffett. I mean, the rule number one is obviously don't lose money. And number two is that never forget rule one, right? And this is actually, it's much. I think maybe a better way to look at it is to think about a bit from a psychological perspective, right? Typically, if you don't manage your risk, you end up losing some money, right? And if you lose money, and which is if it's meaningful, and meaningful is different for different people, you tend to maybe panic, maybe try to exit your positions. I know a lot of people, who exited their positions when the whole crisis in March happened. And now I'm sure they'll be feeling very, very bad because they could have been plus 20%, but they sold at minus 30%, right? So at the end of the day, right, if A, you stay invested, if you go back to rule number one, B, if you are diversified, and then C, of course, if you're managing the risk of your portfolio well, that actually, can ensure that even when corrections happen, they are within your appetite, within your tolerance level, right? And the reality is very simple. If you look at this chart, right, if you see, when you lose, 10%, you have to get 11% to recover, right? As in you have to get 11% more to recover. But as the number goes up, right, and let's take this case of, if your portfolio lost 40%, right? So if the $100 becomes $60, then it has to actually gain by 66.7%, right? To actually, make up for it, right? And I think this is very important to know that, because if you end up losing more, the path of recovery is much harder, right? So if you manage your risk well, and if you can control how much you lose in some ways, right, then, when you're back on the positive trajectory, that is when you can actually benefit and, capture the upside as it gets along in some way also, right? And this is again, something that, we always say, right? And this is something different percentages, right? If you have a 50% correction, you have to almost double. You have to get 100% to actually recover back, right? So don't underestimate the power of losing, because that is something that you have much more to recover. What is even worse is that if it loses, right, and you exit because you are unhappy and you panic and so on and so forth, then that is your so-called realized and captured loss, right? And then of course, this March being a prime example, I'm sure some of you have experienced it firsthand as well. Now, the other thing we say is that obviously stay invested, a bit aligned to the stay about your time in the market, right? And if you essentially, miss out a few good days, right, it can make a massive impact in your output, right? So look at this, example. If you had $10,000, invested for the last like 15 years, if you had stayed invested, you would have made $35,000, like a handsome, 3.5x return for that duration. But if you had missed, the top 40 days, and this is just a benchmark to just show you an example, your actually return would be actually slightly negative, right? So that's the thing about, that, oh, I'll find this day and I'll get this day, you never know when that good day or, bad day is coming your way, right? So the reality is that if you stay invested, and if this platform is built for people who are investing there, of course, if you want to be a trader, there are brokerages out there for what you go and, you take your punts and take your views. And I think that's a separate conversation. But if you're really thinking someone for investment, many of people, they either save for their children's education, their retirement or general growth. I think staying invested can make a very big difference in your portfolio performance. I think that's something to be very cognizant of as you get on your investment journey, right? And this is also like one of my favorite charts, right? I mean, if you look at the possibility of what returns can be for the duration. What this chart actually tries to show you is that if you look at the bottom half of this chart, right, what it's trying to say is that over 1 year, you can have a negative return of, 36.39%, right? Let's say on average, right? Because if it's a bad year and you have to average out the bad years and so on and so forth, right? Now, the reality is as you extend it to over 5 or 10 or even more years, right, that amount of that average negative return actually reduces drastically, right? So if you have invested for 5 years, the average negative return actually just comes down to like about 2% versus a very significant 1 year duration for that matter. And as you grow further, that amount actually can only in fact actually becomes positive, right? So if you're investing for 10-15 years, your net result actually just keeps on increasing with time, right? And that is the power of staying invested over time and staying invested for a longer duration of time, right? Another chart that actually says is this one, right? Now, if you look on the first top bar, this actually shows you, the green shows you positive years and the red shows you negative years. And this is the last 150 years of the US stock market, right? And we're using a philosophy of rolling returns, right? Which means that on a 1 year basis or on a 5 year basis or a 10 year basis. So any period, but in a 10 year basis in some regards, right? So if you look in the 1 year duration, you have a lot of greens, but also quite a few, reds out there. So you will have a lot of negative years, should come in. But as you move to 5, the greens become, thicker and broader. And the reds actually end up, reducing to a very low amount, right? Now, when you go to 10 years, that reds even become smaller, but they're there. But once you go to 20 years, if you see, right, and this is again, for any 20-year period, the markets have never returned negative. No matter when you enter, if you think today is a high or today is a low or whatever, it does not matter. You will have your ups and downs over the next, 5-10 years. But if you're here for the long run, you are bound to win. And that is the key point that we are trying to say, right? So if you are invested, if you stay invested, this will return and will return a positive value over time. And there is logic to this. The logic is that essentially what you're seeing right now, what's happening in the US, and something I'm sure we can talk a bit more about, as money is getting printed, in many ways, the value of money itself starts reducing, right? And the $100 that you have today is not going to be worth $100, in a span of, 10 years, right? So as the value of money itself keeps on reducing, what you really need to do is to somewhere, stay invested and go for assets that are to some extent, I guess, beating inflation per se, right? And conventionally, they used to be like fixed income and, fixed deposits and so on and so forth. But as yields keep on reducing, right, as there's enough money in the world and no one's really, giving you money to borrow money in some ways, right? The chase for yield is pushing people into equity. And one of the reasons also why we've had that kind of rally in the last, 6-7 months with all this money that's, floating around in the market, right? Keeping that in mind, what I'm going to say is that the effective value of money reduces, and hence the value that you generate, one of the best ways to get that value is still remains through equity, because it's one of the most publicly accessible things, which a very wide audience already transacts, and I guess will continue transacting as we get along. Right. Now, the fifth principle is to minimize investments costs. And I guess this is, just an example of, some particular funds that, we compared with, right? Now, if you look at what, a fund on the left versus an ETF on the right, you can see the difference in the fees, right? If you look at this, TER is basically total expense ratio. So if you think of it, right, like Singapore equity, for example, the very first fund, Aberdeen, it's like a 1.6% TER. An SPDR ETF is just 30 basis points, right? Similarly, if you look Asia X Japan, the Nikko fund, the cost is 1.8%. The iShares equivalent is only 0.67%, right? Now, what that actually translates is this is like money directly saved, right? This difference is saved. And this over time starts compounding and adding up to a very significant value in your returns, right? Now, if you look at, for example, the Asia X Japan thing, here the difference of roughly 1%, over time it compounds. And what that means is, though it's exactly the same, like the same benchmark and so on and so forth, the Nikko fund is only generating 7.2% annual return, whereas the iShares ETF is generating 9.9%, right? So, this is the money that you can save out here is money which is yours, especially when you're investing for the long run. All this little thing can add up, and it can be, very, very significant and meaningful in some way, so as to say. And this is again, right, a very simple example. Let's say you were investing, $1,000 and you're paying 2% in one option and you're not paying 2%, right? So essentially, if you start with the same amount and for 20, 25-year period, just look at the difference. There's a difference of 100K becoming, 430K, or you winning 330K, or 100K just becoming 160K. So in a way, what I'm saying is just paying 2% away can eat up more than half of your earnings at a very nominal, 6% return, and markets will give a higher return. So the cost is that is why keeping that cost is very, very important, right? Especially if you are investing for the long run, which is obviously something that we talk a lot about. That's why it's very, very important that you be conscious of this cost that you're paying away for these things, and that's why ETFs sometimes are excellent tools compared to many of the funds. And I know some people talk about aspects like withholding tax and so on and so forth, but they normally forget that all these other aspects of these conventional funds, right, ends up actually far outweighing the negative impact of it, right? And that is actually that's eventually then gets reflected in their performance, so as to speak. And lastly, I would say that, we actually do advocate, investing for a particular goal, right? I mean, this is a little setup where, the do nothing kind of paradox, right? Where because you maybe don't know what you really want to achieve, and you have extreme financial certainty, so you just end up coming to the spot where I'll do nothing. I think this is where online tools like what we have at Syfe, but also essentially speaking to one of our wealth experts like Melvin and all, can really help you better align your investing to your goals, right? But just because you don't have a goal, that doesn't mean you don't invest. I mean, sometimes your goal could be, I just want to grow my wealth, and that's a great goal. I think a very popular goal on our platform as well. But I think it's something that you should keep in mind. And if you have, I guess, more short to medium term kind of goals over the next 3 to 5 years, then you can have specific optionalities, and you can go for, let's say, lower risk options because you want lesser variation, right? That's something to keep in mind. So to summarize, right, the 6 principles are here, right? It pays to invest today, right? The earlier you invest, the more you have to gain, right? Secondly, don't put all your eggs in one basket. If you can put in a diversified basket, I think that is the right way to do. Again, the past is not a guarantee of future returns. So don't just think that you'll get, if tech is the hot sector this year, doesn't mean you'll continue being every year, right? Third thing, obviously manage risk, and this is personalized. It's everyone to an individual. Remember the rule of not losing money, and you're not getting emotionally biased and exiting just because you've panicked out. Then the fourth one is to stay invested, right? The longer you spend in the market, time you spend in the market, you are more likely to win. And this is something, which we've showed you in numbers earlier, right? Over 20-year period, you will always and always come up positive. Fifth, minimize your investment cost. That 2% difference on a year might not sound a lot, but in a span of 20, 25 years, it can eat up more than half of your gain. So that is very, very significant and something to keep in mind. And lastly, align your investing to your goals, right? If you have, short-term goals, short-term needs, then don't essentially take very high risk products. If you're investing for a very long time because you have time on your side, a high risk option can potentially work in your use case. With that, I can see a bunch of questions coming in, Melvin. Should we pause a bit for some Q&A before we move on?
Yeah, definitely. So I think an interesting question is, how do people actually determine buy points? Do you recommend people just place in money, not timing the markets, or do you prefer people to actually just place it on a regular basis versus like timing the markets, for example?
Sorry, Melvin, what was the first part of the question? How do people?
How would you rather people invest, like via a monthly regular plan or simply just timing the markets,
Yeah. It's a great question. So as you can see out here, like having time on your side can be one of the best, weapons that you can have on your side, right? So if you have the resources, I would say put that lump sum and, place it in and go for it, right? But then be prepared. This is a long-term investment, and, even if it comes down by 20% next year, you will stay committed and you'll stay invested and not do that same mistake that people did in March when the markets cut and so on and so forth, right? Now, the reality is that if you are a salaried person or, you're just starting off and you might not have that significant lump sum amount of money, then even doing a DCA or a monthly kind of setup can be very, very effective, right? So what we normally see is that people normally put a lump sum and then they follow it up with a DCA. And I think that's a great kind of a way to do it. I think doing a DCA silently keeps on building a habit. And, a very good thing that people do is that they just set up an auto pay on their bank account, right? So I get my salary and, a few $1,000s every month then goes directly into Syfe. And it's like an auto pay. It's already set up. Everything is already done. So psychologically, my salary is a little bit lower than I would have liked. But what I'm actually silently building separately is this pot. And over time, this becomes very, very significant, right? And this used to be very expensive to do, or is still very expensive to do if you do it yourself through a brokerage and so on and so forth. Because when you're investing small values, the minimum costs and all that don't really make sense. But now with digital wealth solutions like ourselves, this has really democratized, and you can even invest, even if you save $1,000 a month, you can invest that as well, right? So which was perhaps like unheard of and very complicated, and you could fill up forms and so on and so forth. Now literally you transfer the money, put the portfolio code, everything else is taken care of.
Great. So between the regular plan, right? Would you say that there's a difference between investing monthly and weekly?
No, not really. I think don't micromanage it. I mean, at the end of the day, I would say, as I said, if you have the money, you should invest upfront. Otherwise, typically monthly works because then you typically have a salary and so on and so forth. There is no proven data that weekly is better than monthly. I would always say that if you can do it monthly, I'm presuming your source of funds are coming, at some point, right? So I would say if you can do it, then you have that extra few weeks over long term, it will be a positive, impact, right? So I would suggest that, I mean, if you don't really have a strong reason to do weekly, there's no need to micromanage. Having said that, we have a unique case of a customer who religiously puts money every day, right? But I think that is more because, I think he's got a unique view of it. But I would say majority of customers, they normally do monthly. And then of course, when they have bonuses or special payouts and all, then lump sums and then significant lump sums, keep on coming as they get on.
All right. So do you think Syfe is suitable for clients that just want to park a lump sum and not worry about it for the next 5 to 10 years time?
Absolutely. I think this is the whole point of the platform, right? That you are going to pay very low fees, very transparent fees. And also we will manage it for you, right? Like whether it's managing your risk or rebalancing, or, if you're investing, let's say in a REIT product, we reinvest your dividends, and that's so small things, they all add up very significantly. I'll give you a very good example, right? Especially on this point. Just by reinvesting your dividends on REITs, you can increase your portfolio performance by 50 basis points, right? This is proven. You can look at last 10-year data, right? Now, when people normally have their own REIT portfolios, they can't do this because your dividend is too small. Even if you have $100,000 portfolio, your dividend might just be about $200, right? Now, to invest $200, you have to go online, log in, and then pay a minimum of $10 brokerage and all. Nobody does it, right? Because doesn't make sense. But with platform like ours, by just about like by this virtue of automatic reinvesting, you just keep on compounding over time, and net this becomes a very, very positive effect. And I would say, it's a great tool for people who are especially looking for someone managing my money, and I don't have to look at it. But everything is transparent. You can take out the money anytime you want. You can speak to Melvin and the team at any point you want, and understand a better what's happening with your portfolio, if that is what you would like.
Great. So thanks for your answers. Do you see any questions that you're interested in answering first before we move on to the next part?
Yeah, I think I probably will have to give me 1 second. I might have to. Oops. 1 second. Let's see. Right. I see. Bunch of questions out here. Yeah, someone's asking, do you have an option for auto invest directly? Absolutely. A lot of people actually do that, and that is an option. So you can set up a standing instruction in your bank account, and that is great. You can modify, add, decrease, do whatever you want on that thought, right? So I think that is there, right? Now the other question that is getting asked is that how is Syfe different from other robos? So I think first and foremost, like we basically are different in a way that we don't think that we're a robo. We are more like a digital wealth management platform. And I think one of the big differentiators is that we have a human touch. Like Melvin actually is from the team which are the Syfe wealth experts, so as to say, right, which can really help see how our products align to your goals and help you understand these better, right? I think this is one thing which is very unique. I think the second thing is we genuinely focus on risk, right? There's a lot of aspect of risk management in all our portfolio creations. Even in the REIT portfolio, for example, you have an option of risk managed. When we look at our equity 100, it's maximize risk managed returns. I think that truly focus on risk is a big differentiator. And even the team that we have, right? In fact, Richard, who heads our investment team, right? He basically used to teach portfolio construction and risk management at NUS, and of course has had a glorious career in finance before that, where he was the CEO of UOB Venture Management and so on and so forth. So I think that genuine focus on risk is something that you see, and it is very, very unique for us. And third, and the thing is that, product innovation, right? I think what we've done with Equity 100 and what we've done with REIT, we're the only one who has a REIT offering available out in the market, which has been doing extremely well. And that is some trend, which you will continue to see. So to summarize, I would say human touch, unique proprietary products like the REIT one, which we built with SGX, and thirdly, a genuine focus on risk puts us, I think, in a very different league compared to many of these other, robo advisors that you refer to, right? Do you have investment portfolios for China and emerging market? Not yet, but we're working on something very interesting. At some point, we might be able to, help you with this. In the meanwhile, you can feel free to reach out to our, support team. Just to add, we do have something in these products already for accredited investors. So if you're an accredited investor, feel free to reach out to our teams. And if you want, we're happy to share. But we are trying to do something very interesting for the broader audiences also, and something that we look forward to do it. One thing to add though is that we do have a global. Our portfolio is generally global, so they do have China exposure and emerging exposure via EM, etc. Of course, they're a bit more global, so they obviously have their weights towards US, Japan, and Europe. So the EM weight is a bit lower, but or the emerging weight is a bit lower. But again, if you're accredited, we can solve the solution for you right away. But in case you are a retail customer, please bear with us, and we'll come up with something very, very interesting. Someone just asked me which one would be recommend. Should I go to the Hong Kong market? I'm not really sure. I understand that question well, but I guess I guess a conventional brokerage, if you're looking for like specific Hong Kong specific thing, probably go through a brokerage setup, which might really help you. And again, if you're a credit investor, then probably we can help you with something a bit more customized for you. What else? What else should we do? Should we just carry on for a bit and then come back to this?
Okay. We can leave some questions for the end.
Oh wow! Actually, let's. Actually, I see a lot of questions. Let's sort of get them. So Sumit has asked, why are ETFs better than funds? Like almost always they are better than funds, right? The reality is that the way how ETFs are structured, they have a lot of efficiencies in their structure, which make them much more, how do I say, cost effective to operate. So on average, ETFs have significantly lower cost than funds, like massively lower, and that goes to advantage. Plus ETFs are very like liquid, right? You can trade in and out. You exactly see on screen what's happening. With funds, it's always a bit of a black box, right? Like, oh, what is the NAV? Where will it settle, and so on and so forth, right? So especially when markets are volatile, if you want to know at what price you're selling or what price you're entering, I think ETFs give excellent, output. There are certain cases where funds might be better, like some very specific, local or emerging country kind of, fixed income products. There, the ETFs are not good because they're not very easy to trade and they're not very cost effective. But generally, for a broader portfolio, I would say 9 or 10 times ETFs will end up proving better than funds, right? I might be biased because I used to run the ETF desk at UBS, but the reality is that this bias is based a lot on numbers and data, and actually the premise once we actually had started Syfe. When someone's asked like, what's the thought on the ETF bubble? So I think this is a question that we got asked long back. I think this emerged a lot, I think, earlier in the year, and now as markets are rallying, this thing is coming again. I actually don't think ETF is a bubble. If you think of it, what ETF is, that essentially an ETF is a collection of stocks, right? So I'm not sure if you know how, if you're familiar with the term of ETF creation and redemption, but typically, let's say if you're buying anything meaningful, right? I mean, small size you can trade in the market, but you're buying anything meaningful, you actually go to the fund manager. So I'll go to a BlackRock, I'll say, okay, I want to buy $50 million of their SPY, their S&P ETF, right? And what they will do is they will actually go and buy the underlyings in the market itself, right? So if you are calling ETF a bubble, then actually you're saying the stock market itself is a bubble, right? ETFs are just replicative of what's happening in the markets. And in fact, there are a lot of teams, and in fact, we at UBS also used to do this, where if ever the ETF price is more value than the underlying prices, right? We actually end up, there are these like businesses built on ETF arbitrage, where if ETFs are undervalued, what they will do is that, if ETFs are overvalued, they will basically, redeem the different, I guess, pieces of the different, underlyings of it. And you can literally physically ETFs, like you can give an ETF and you can get 50 stocks, right? And then sell the 50 stocks, right? Because, you'll end up getting much more value out of it somewhere, right? And the other way around also, if ETFs are like, undervalued, to some extent, right? Then of course that you can have that arbitrage by just selling the stocks, right? So essentially, they are like businesses which are literally built on ensuring that this difference is minimal. So it's not really a bubble; it's a replicative of the marble. And if you think the ETF is a bubble, it's basically saying the stock market's a bubble, right? Which is a different question, and I'm happy to take that up if someone wants to take up that at some point. Now, someone's asking, what do you think of actively managed funds versus ETF? Is it worth paying the age of exactly? So yeah, the question is that so it's a good question. He's like, for the sake of the audience, what do you think of actively managed funds compared to ETFs? Is it worth paying the extra fees, since now we are in the age of disruption and ETF tracking, and indices might inflate companies which are not fundamentally as stable as it seems, right? So as I said, right, I think the indices themselves can't, right? I mean, people are looking for access and people will end up, going and getting them either way. But the reality is that historically, and I think we have this somewhere here, let me see if I have it, right? I don't know if this can be seen by the audience, right? Essentially, if you look over time, right, active managed funds, right, and this is again that 15-year data, right, only about 5% of those funds have, beaten the benchmark, right? By and large, they always underperform. And as I said, the reason is you're paying that fees for nothing, right? So frankly, and the reason I say this is also, it's very simple, right? I think there was a place for active managed funds and all, which was in the 90s and all, but there was a lot of information disparity, access was expensive, and so on and so forth. Today, most of the times, fund managers know the information when and you know from the same channel, it's called WhatsApp, right? So because that information disparity is gone, their edge has gone. So right now, the only cases where fund managers can probably have some upside is where it is like restricted markets, right? Where, there's still a level of information that is transforming, which might not be as easily accessible. But by and large, like as you can see, right, passive far outperforms active, right? And you're paying a much lower cost. And especially if you're investing for a long duration, then it's almost a no-brainer that is a direction, that we should essentially be heading down, right? Should I park? Right. So someone said, like, should I park all my money in equity 100 or divide between REITs and equity 100? So I feel this is a lot about person to person, right? At the end of the day, you can speak to a wealth expert to get a better understanding for you. But the goal of the product is different, right? Like the REITs product is more targeted at those looking at yield and something in Singapore dollar. Equity 100 is though looking for a high risk, high reward, and a global diversification, right? So when we talk about alignment, to your goals, that is something which is very very relevant, right? I think it's a case by case thing. There's no real one size which fits all, right? Right. The next question that's asked is that do you recommend diversifying across all the other robo advisors? So I'll be honest, right? I don't think there is a real value. Like you're anyway diversified a lot with a particular robo advisor, to be honest, right? Now, so there's no real value. Like there's anyway this massive. They have a diversified portfolio which has diversified ETFs. So there's enough diversification is already happening there, right? Now, the only risk you run is if you go with the risk you run is that there's a counterparty. What if something happens to the robo advisor, right? But there generally, I can't speak for the others, but at least in our case, it's actually very clear because because of the NS licenses, we are audited by the Big Four. There is compliance. Your assets are safeguarded in a different custody, and so on and so forth. So, God forbid something comes to happens to us, right? Your assets would still be safe, and because they're after all your assets, right? But generally, I see the only real value to go to different robos is if they have a product which the other guys don't have. But purely if you're looking for, let's say, an equity 100 and then you put it in 4 with the highest risk, I really don't think there's much value in it, right? That's my view on this, right? Right. What else? The next question. What is the difference between ETF and REIT? So ETF is typically what is an exchange traded fund. It's a basket of stocks typically. So let's say if you take the SPY ETF, right, one of the most popular ETFs in the world. This will basically have all the 500 or whatever components of the SPY index, right? Then if you have a gold ETF, it will have a component where it's looking at gold and so on and so forth. Then if you have a bond ETF, it will have multiple bonds, so on and so forth, right? So typically ETFs generally are diversified and they basically they are across, they can be either focusing on a country, on a sector, or an asset class, right? Generally, they are across companies and multiple companies. REIT is a single company thing, and REIT stands for Real Estate Investment Trust, right? Essentially, this is a tool that real estate providers use to raise some money from public markets like this thing, right? They're actually not really an apples to apples comparison. I mean, think of REIT is probably closer to buying a single company stock in some ways. ETF is more like buying a basket of stocks, so as to say. But I think one of the interesting points of REIT, which make it so attractive, and it's a bit lucky that we are in Singapore, which has a very active and vibrant REIT industry, is that REITs by law are supposed to pay 90% of their dividends away. So 90% of their income away as dividends, right? Which is why REITs end up yielding between 4 to 5% dividend yield, and it's fairly predictable. And this is one of the reasons why people really like, especially as your bank rates really keep on going down. That is one of the key differentiators. But again, at a high level, REIT is a single company, real estate focused only. ETFs are generally across companies, across sectors, as the case might be, right? Great. What else? So someone has asked, there's a projection forecast feature for global RE and REITs, but the feature is not for equity 100. Yeah, I think this is a good question. I think the reason for that is because some of the components that we've actually used are actually quite unique in building a smart beta thesis. And generally, given that some of the products that we're using itself are recent, right? There wasn't enough conviction for us to really build a forecast model that we are super comfortable with just as yet. So we are still working on iterations on something that makes sense, but this is something that will, get fixed, right, in due time. Cool. Then someone has asked, what's the difference between Syfe and Poem, right? So Phillips, I presume that's, is that like a
brokerage?
A brokerage, right?
Correct.
So could you maybe answer what's the difference in the two, if you don't mind?
So unfortunately for Poems, which is a brokerage, you actually have to pick out what you want to invest in, right? So think of Syfe as we are offering you a managed portfolio. So we are doing most of the legwork. But if you go to a brokerage, you would have to, do your own homework, decide what to buy, manage your own portfolio. And of course, you have to think about the cost considerations as well. For every trade that you go through from a brokerage, you would actually incur cost. between buying or even selling it, right? You receive the dividends, you want to reinvest it, there's another cost right there.
Yeah.
So for Syfe, we actually handle every aspect of it, from the selection of securities to the purchase to the rebalancing, and of course reinvestment options if you would select so, right?
Yeah, good. There's one more question I think which maybe you can take, Melvin.
Okay.
Someone's asking that, like, what would you recommend a millennial who has just started their career, REITs or equity?
So typical for millennials is that they would be going for growth unless you are a millionaire millennial, which want to derive some form of passive income from just investing into REITs, right?
Yeah.
So typical millennials would actually be going for growth, right? They want to turn that $1 into $2, that $2 into $4 in time. So pertaining to REITs is that there's more of a distribution strategy in focus, right? You derive something tangible compared to perhaps equities whereby some gains are paper gains. So for the older clients, this is perfect for them because they are not exactly chasing returns in the forms of paper gains. They want something tangible to make up for their main income or even to offset certain form of expenses. So millennials, they typically go for growth, which actually equities kind of fulfill much more than REITs. But over the last 5 years, REITs have presented themselves to be really attractive, even from the growth perspective. So you can think of REITs delivering both growth and income, should you so choose REITs to be, right? But personally, I can't pick one or the other for you. I can only, kind of tell you what's the pros and cons of each. So a good way is to go through the risk analyzer and you can actually determine which is better suited for yourself.
Great. Okay. And then someone's asking that would we like Sylvia's being that do we meet potential clients or everything is done online? I think this is a great question for you, Melvin.
So typically for client meetings, we actually do it for a more committed client. So typically the first phone call is definitely necessary. We can't just meet you without giving you a call. We don't want to turn up there and then there's no show and all. So we do client meetings. So if you like something scheduled, do send in your request. Let me just drop the link into the chat later. So you can
put the link to book a free complimentary session. Yeah, and I think Sylvia, that's something that a lot of people actually find a lot of value, right? And I think someone's again asking like, what is like the difference between Syfe, right? And says the focus on risk, the innovation on product like REITs, and the third thing is the human human touch, the team that Melvin's a part of, right? We have been meeting clients before the pandemic. Thereafter, it's largely been how do I say over Zoom. But the case requires we can take it case by case. So feel free to book a session. And Melvin, if you can just drop the link out there, I think that'd be great, right? So great. I can maybe take one more question on this one, right? Like someone's asked that, isn't investing in robo-advisors very similar to investing in active managed funds, since robo-advisors are the ones managing the funds? Not really, because the thing is, active funds are a bit of a black box, right? Because they will do what they will do, and you really have no control, no say, and so on and so forth, right? Whereas when you invest, let's say through a fund like like Syfe, for example, you know what you're getting into. For the REIT, you're getting into a REIT index, right? Or if you take the global risk product, you choose a risk level. We try to keep that goal within the risk level, right? So at the end of the day, the robo advisors or other like us, right? We actually are a more methodical, and we basically like take a lot. We kind of play by the rules in some way, which is the passive investing setup, which has far outperformed active. If you remember, my previous screen, right? But this is something which we really want to how do I say, which we want to really address, because at the end of the day, when you go to active funds, you're paying all this premium for things many times which might not really be worth it, right? So I think it's very different. And plus, with robo is very simple, right? You basically park your money and everything else is taken care of, right? Whereas with funds, you have to go and choose the fund, then monitor them, then invest, reinvest, or so on and so forth, right? One for you, Melvin. Someone is saying that I'm hitting 43. Is equity still better for them? What's your thoughts on that?
You're hitting 43, but what is your investment goal? So if your investment goal is for retirement, so between 43 to your retirement age, if it's still quite some distance, and if your current retirement fund is still far from what's required to retire, let's say on target at 65, then of course you need to have a focal point towards equities, right? Because you can slowly build your REITs portfolio over time, but your objective should be accumulating that lump sum on retirement age that you can actually park into a high yielding portfolio, for example, like our REITs portfolio, right? Not necessarily into REITs, but you can also choose REITs if you want to deliver that income, which allows you to actually retire or offset your loss of main income on retirement.
Yeah, exactly. And that's also right, as I said, because it's such a case by case thing, right? So actually, doing it, getting a session from that link that we have shared with one of the advisors can be very, very helpful, and something that a lot of users have really, really found value in, right? Great. Let me try to get through some more slides. Otherwise, we will never, get on with this, right? So let me keep this brief, right? So we always say right, that, we try to say that, we should be smart with your, investment strategy somewhere, right? Specific, measurable, achievable, relevant, and time-based, right? And just a simple example, right? Like if somebody wants to carry a break at 45 and they need a 6,000 cover, how much amount should they need, and so on and so forth. Now they are like very good like forecasting tools and all, including the one on our website, which can really help you, achieve these things, right? So something that you can really do, and again, something that you can reach out to one of our wealth experts to help you with, as the case might be. Right. So then the next one is like how can basically Syfe help, right? So I think some of you already know about our portfolios, but for those who are a bit new to us, I mean, essentially we have three main portfolios. The first one is the global portfolio. This is across equities, bonds, and gold. It has 11, downside risks. The goal is to manage the risk of your portfolio. And traditionally, you can see the returns of the last 10 years, the average, return is roughly about 8%, right? And this is very well diversified. It's across asset classes, across geography, across industry sector. Now, our more recent launch was Equity 100 in the middle. This is pure equity. This is completely focused at high growth companies. This is again, this is that high risk, high reward kind of a setup, right? This has about 1,500 stocks from the best companies across the world. The annualized return is 13.2%. Actually, I think it's even a bit higher now after the move up again in the last few weeks, right? And this is actually built using a smart beta strategy, which actually gives higher risk-adjusted returns. Now, we actually have dedicated webinars on this, so we can definitely talk more, and or you can reach out to us for more questions. But the goal again here is something for you're happy to take a slightly higher risk, but obviously with a much higher return. And especially if you're investing for the long duration, I think it's a great tool because it's almost like you're saying a part of my net wealth is always and always remained in equity, and there's no like bonds or gold as the case might be. And lastly, for those who require something a bit more Singapore, a bit more passive income, it's the Syfe REIT Plus, right, which was built in close collaboration with SGX, right? And this is, again, a very, very unique product. I think we are the only ones, I'm sure we are the only ones who have this product. We're the only ones who actually track this index. And it's a great product, very well liked. And the dividend yield is about 5.1% last year. This year, I think even after the correction, it's still roughly about 4% or so. So still very, 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 very solid in some way, right? And then in this REIT, you even have an option of adding risk management, where if you want us to manage the risk, how we do it for the the global portfolio, we basically can sell some of the REITs and buy bonds to keep your portfolio risk managed in some ways. Now, the beauty is that if you're not sure what's right, we do have an advisory team, as you can see at the bottom, right? You can speak to the Syfe experts to understand a bit more about these products and see how they, fit your goals. Because no matter how detailed we make our websites and how much we try, a few things obviously I think are better, spoken. So we'll be happy to help you there as relevant, right? The way to sign up is very easy. You can either do it through the app or through the web. It's very simple. You see a portfolio recommendation. There's a forecasting tool which you can see how it really works for you. And lastly, there's a very simple tool that can help you monitor, how much you've invested, what the current value is, what's the growth, and so on and so forth. So very easy to add, very easy to remove, and so on and so forth. Now, the key premise of this, right, and versus using, let's say, active funds and so on and so forth, is the transparency, right? There is no trading fees. There is no entry exit charges. There is no minimum balance. You can even have $1 if you want. You can withdraw as much as you want. And there's unlimited rebalancing. If you move, between portfolios and so on and so forth, you can do it as much. I would like to caveat it that, generally there's no, if you have a plan and if you stick to your plan, there is no reason for you to be switching around, but that optionality exists, right? If you switch around too much, you might miss the high and low. And also we just say, stay invested, like align your investment to your goals, and you will never have that, urge to punt and, take these calls, which normally don't go anywhere, right? And then, of course, people say, what's the option? Why don't I just do it myself? I mean, the reality is that, a lot of things, right? Like there's no minimum investment. If you're in Singapore or abroad, you don't need a brokerage account or CDP. The time required is just less than 3 minutes if you're coming, especially through my info. You have risk management, you have auto balance, the automatic dividend reinvesting, one of my favorite features, right? This actually pretty much pays for your fees itself, right? And this is a very, very unique proposition. There is no brokerage fees, and the management fees is very, very low, right? And those active funds typically, and unit trusts and all, they normally go 1.5% and above, right? So essentially, this whole thing is something which is very, very, how do I say? It basically makes your life very simple. If you think of it, we think of ourselves more like a digital wealth manager, right? Who's built this end-to-end solution, but we have that human touch should you need, right? We have people like Melvin and his team who can really help you, understand these things better and see how they better, suit your use case, right? Also, as you progress up, in the thing, your fees actually gets lower. So if you go to, the black and gold tier, your fees actually comes down to 0.4%. The minimum investment, of course, is 20K for black and 100K for gold. But you do have access to wealth experts, right? Which you have continuously in black and a dedicated one in gold. Now, for the platinum, for those customers who are looking to invest more than $500,000, we actually do have some incredible, customized offerings. You probably will fall in the AI bracket as per our perspective. So, do reach out to us and, we can probably build something very nice for you out there as well. And then, of course, feel free to come and, join us in our subsequent webinars, Thursday, 7 p.m. standard time, block your diaries for some Syfe time. We are having Timothy Ho next week from Dollars and Cents. So get some broader perspectives across the market and other products as well. And then a more retirement focused session, which we are doing on the December 10th. Now, with that, we are coming towards the end of our, I think this is not really updated yet. So I think this is the old one. So I would probably just skip that. I think the link is still the same, but yeah, I mean, if you do sign up from here, basically you get 3 months of what? I think it's 6 months of
6 months.
Yes, 6 months.
6 months.
6 months of $30,000 managed for free. So for 6 months, you can give us a try at no cost to you, right? So get started, and I think fill in a small survey, and we'll be happy to help you. With that, we are coming to the close of our webinar, and we would love to take some questions, right? Let's see. What is the difference between ETF and ETF index? Which is better? I don't know if you refer to an index of ETFs, because that's not very common, but I think you probably mean to say like the index itself. So generally ETFs, exchange traded funds, they track indices, right? So essentially you can't buy an index, you have to buy a product that gives you access to an index, right? Which is ETF in this case, right? So they're two different things, but typically a good ETF is benchmark that it is very closely tracking the index, which is its underlying index, right? And that's the key difference between those two, right? Then HM is asking us that recently some REITs raised money from shareholders. How does Syfe handle offers like that? What does it mean for investors? Difference versus investing in Syfe and buying the REIT myself. It's actually a very good point, and something we don't talk much about, but we actually have a mechanism on our side where we do subscribe for rights when it makes sense for us to subscribe, right? So we run numbers, and if it's over a particular threshold, we automatically subscribe for rights for you. And this is great because the cost and effort and hassle that you have to go through to do it yourself will be significantly more than us just doing it, and it's automatically adjusted. We keep a small cash buffer in your portfolio for these occasions. For example, like A-REIT, right? We will be subscribing anyone who has, they will see the subscription, and on the pay date, they'll actually see it paid also. So essentially, with Syfe, they've taken that pain away from you, and we're just basically doing it for you, right? Great. Then the next question is that markets have been very risky. How do I know when to buy and start investing? See, there'll never be a right time, right? I mean, even a month ago, everyone's like, market is too high, sell, and it still keeps on going up, right? The reality, yes, I do agree that markets have run up this year. So is it possible that we expect some sort of a correction in the next 1 or 2 quarters? It is, right? I mean, it's anyone's guess right now, right? But right now, most of the news is coming out positive. There's positivity around the vaccine. People have kind of accepted this, wearing a mask and going out and meeting in groups of 5. So generally, like there is no real, I guess, event out there, but anything can happen, right? So the reality is that if you don't need money in the short run, uh, a great time to start investing. Well, the best time was yesterday, but today is your second best option, right? The reality is that even if you have that little correction over time, that will phase out, and you will still end up in the green and end up in the positive, right? Now, if you do have short-term commitments, right? In that case, typically a lower risk product, a lower risk offering on the Syfe Global, or maybe a REIT product with risk management might be more suited for you, right? But again, if you're going to try to find that perfect time, trust me, we've like I have, there's never there's never going to be that time, because today's high is tomorrow's low and vice versa, right? So don't try to work on that. Is Syfe working on new portfolios? Always. We are always working on very, very exciting things. As I mentioned earlier, we do have something very interesting for accredited investors already. So if you are in that category, feel free to reach out to us and we'll be able to guide you better. But other than that, stay tuned and you will see some very exciting changes for us in the next few months. Especially as you might know, we've closed a very significant fundraising round about 2 months ago, and a lot of that has actually will go in dedicating more resources, adding more team, and adding more energy and more product diversity in our suite for that matter. Great.
Questions from
Okay.
Facebook actually. Shall we do the two?
Yeah,
two interesting questions. Yeah. For the equity 100 portfolio actually, so will Tesla be included into our portfolios once it's tracked by the S&P 500?
So yes, because we have SPY within that portfolio, which will also have Tesla. And correct me, isn't Tesla part of QQQ already?
I think
it is, right? So I think we are already tracking. Let me just actually confirm on this, right? I'm almost certain that we are actually already tracking Tesla. So yeah.
Yep, it is.
In fact, so we already have, and that's one of the reasons why our portfolio has done so well, is that because we've had Tesla, and QQQ is actually the biggest weight in our equity 100 portfolio. So actually, and QQQ is the largest holder of Tesla, by the way. So you already have exposure, but that exposure will only increase after the SPY inclusion.
Another question. So is equity 100 portfolio considered an active portfolio?
Not really, because well, I would say it's
base, right?
It is. We do rebalance the portfolio twice a year according to factors, but this is like, I don't call it active because it's not like we wake up one day on the bed and say, oh, add QQQ and remove SPY. So it's a very systematic thing which happens on the movement of factors, and this is something that maybe we can talk a bit more in the equity 100 focused webinar. But these factors actually move very, very slowly, right? Very rarely you'll have a very, very massive move, right? So you will, even if there are variations, they are generally very, very small. And I would say that the portfolio is probably more like 90% passive still in nature, right? So I would not really call it an active thing. Right? So the thing is that we are trying to optimize the tools that we have within a bunch of passive products, because our view is that the active products underperform and they are more expensive and they don't make any sense. So you will get a much better output than this, right? I can assure you that for example, not was I think less than 5% of active funds this year would have beaten SPY like every year, right? If any, right? But generally they always, it's too, the information flow is so rapid and diverse that they really can't act on it the same way they used to do in the past.
Great. So that's about it for the questions. I think we answered everything.
Awesome. All right. Okay. Well, this is good. I think we are, we are coming nice and early on that. So guys, again, if you have any specific questions, feel free to reach out, or you can schedule a free call through the link that Melvin has shared on the chat. Thank you so much for joining us today. And thank you for your support. And just, stay with us in the next couple of months. We will come up with something very, very exciting, including changes on the app and, launching some new exciting products. Thank you, everyone. Have a great evening, and look forward to see you guys soon again.
All right. Thank you, Dhruv. Everybody, have a great evening ahead. Cheers.
Thank you, Melvin. Bye.
Bye-bye.